Hello, everyone. Thanks so much for joining us today for the Back Mountain Chamber's annual Federal Reserve update. I'm Jack Jones, Regional President for Luzerne Bank. We are a community bank with 9 offices located in Luzerne County, 2 of which are located in the beautiful Back Mountain. We offer a variety of solutions for all your banking needs, from business loans to consumer home equity lines of credit. We also offer property and casualty insurance through our company, United Insurance Solutions. Please stop at any of our locations and our friendly staff will assist you. Luzerne Bank is proud to be the presenting sponsor for the annual update, and we are also proud to be a chamber member since its inception. The format is different this year from years past. We are going virtual instead of enjoying breakfast and an in-person presentation. This year, our presenter, Ryotaro Tashiro, Regional Economic Advisor, is again sharing his insights and perspectives on the economic climate and key issues. I'd like to share a bit about Ryotaro. He is a Regional Economic Advisor in the Research Department of the Federal Reserve Bank of Philadelphia. He informs external audiences on national and regional economic conditions, monetary policy, and the role of the Federal Reserve in the economy. You'll find his impressive bio contained in this email. Please click the video below to watch Ryotaro's update this year. I always enjoy the question and answer segment of his presentation, and don't worry, this year that component has not been excluded. After you've watched the presentation, please email your questions to team@backmountainchamber.org by Wednesday, November 11th before 4 p.m. The Chamber's team will forward all questions to Ryotaro, and he will provide us with a follow-up video to be shared with you on Monday, November 16th via email. I, along with my colleagues at Luzerne Bank, are excited to bring this content to you as the presenting sponsor. Now, it's time for me to pass the spotlight to Ryotaro. Thank you.
Hello, and thank you for joining me. For those of you who don't know me, my name is Ryotaro Tashiro, and I work in the research department of the Philadelphia Fed. Every fall, I have the pleasure of addressing the Chamber during the annual economic breakfast. This year, we have changed the format to accommodate the current situation. This pre-recorded presentation will last approximately 15 minutes, and I will address a few key questions related to the economy. You can send any questions or comments to the Chamber staff over the next few days, who will compile the questions from the group. I will then prepare written responses to all the questions, which you will receive when I have the answers ready. While this is in no way a perfect substitute for the in-person discussion we are used to having, I hope that it will help you understand some of the key concepts and developments in the economy. I would like to make a couple of announcements before we get started. First, during this rapidly changing environment, it is important to point out that this presentation is being recorded on November 6th, so all data used here are the latest available statistics as of that date. Second, as always, I need to preface my presentation with a standard Fed disclaimer. The views expressed here are my own and do not necessarily reflect those of my colleagues in the Federal Reserve System. With that out of the way, let me start with a graph of the gross domestic product to motivate the key questions I would like to address. As you already know, the U.S. economy experienced a record-setting annualized decline of negative 31.4% in Q2 before recovering at an annualized rate of 33.1% in Q3. Despite the strong recovery, it should be noted that we are still below pre-pandemic levels in terms of economic activities. During this time, consumer spending and business investments were the main drivers of the contraction as well as growth. Together, they account for more than 80% of our economy, so when we discuss economic trends in the US, it makes sense to focus on these components. While there are hundreds of interesting questions we can ask ourselves, in the interest of time, I have chosen to cover 3 questions today. First, we will explore the impact of the pandemic to businesses. Second, we will take a look at the reaction from consumers. Finally, we will discuss the outlook for the near term. I will begin with a discussion of the first question: what has been the overall impact of the crisis to businesses? This chart shows the percent change in net revenue of small businesses relative to what they saw in 2019. As you can see, the figures dropped significantly in April and May, but have recovered substantially since then. Having said that, you also notice that these figures have essentially stayed the same since mid-June, which suggests that the pace of recovery has slowed down, and we have a long way to go until full recovery. When business conditions change, they tend to show up in labor market numbers, and this crisis has certainly been no exception. In the next few slides, we will look at how the labor market has developed in the recent months. Each of these colored bars represents the monthly net change of payroll employment. For example, the last bar all the way to the right shows that we have added approximately 638,000 jobs on net in October. After declining by 1.4 million in March, the US labor market experienced a record-setting net loss of over 20 million jobs in April. While the data since then showed some improvement, it should be noted that we're still over 10 million jobs below where we were back in February. Again, just like the data from the previous slide, we see that the pace of recovery has slowed down in recent months, and that we're a long way until full recovery. When you examine labor markets for each state, you'll notice that there's quite a regional variation. Several factors contribute to this. First, there has been considerable variation in terms of the spread of the virus. In general, labor markets of states with higher COVID cases suffered relatively more. The state of New York, particularly earlier in the pandemic, is an example for such cases. Second, we saw varying responses from state and local governments so far, which had different effects to local labor markets. And third, states that have higher dependency on severely affected sectors were more negatively impacted. An obvious example for this is Hawaii. The state's labor market has higher dependency on tourism and related sectors. As those industries suffer, the overall negative impact to the state's labor market has been greater. I would like to further discuss this last point about the industry mix in the next two slides. This map uses the same dataset you saw in the previous map so that we can focus on our region. Here, you'll also notice that there is quite a regional variation. Key drivers for that are varying dependency on sectors that were most affected and varying damage to such sectors. For example, in the case of New Jersey, Atlantic and Cape May counties suffer the most as a result of the pandemic, as the area's labor markets heavily rely on the leisure and hospitality services sector. Similarly, employment in Sussex County, Delaware took a significant hit as the region relies heavily on tourism and related sectors. While most sectors were negatively impacted, it is clear that some sectors were much more severely impacted than others. For example, the leisure and hospitality sector in the Scranton-Wilkes-Barre metro area, which includes jobs in food and hotel services, experienced more than 40% reduction in employment compared to September of last year. This represents a loss of more than 10,000 jobs. In the interest of time, I'm only showing the data for Pennsylvania, but the data for a typical state looks similar as well. In this slide, we use a dataset that contains a near universe of all online job ads to examine the demand for specific jobs in Pennsylvania. We're interested in comparing the number of job ads for each occupation in September of 2019 versus the same data in September of 2020. The green table on top shows the occupations with the sharpest increases from September of last year to this year. Many of these jobs include logistics jobs, such as order fillers and laborers, as well as jobs in personal care sector for both humans and animals. In contrast, the red table at the bottom shows some occupations with the most significant drop in the number of job ads. Many of these are client-facing occupations, such as skincare specialists and office machine operators. All of these labor market indicators can be useful in predicting which industries are likely to grow in the next few years and which sectors are likely to further decline. In the next section, we will explore the reactions by consumers. You will see that the overall trend is directly tied with our discussions in the previous section. This chart shows the monthly consumer confidence indexes in the US. We see that consumer confidence dropped significantly in April and actually remained at low levels since then. As a result, we have started seeing changes in consumer behavior, both in terms of what we're buying as well as how we're buying goods and services. We will explore some related data in the next few slides. First, one immediate impact of the pandemic to the consumers has been the sharp increase in personal saving rate. In April, it jumped from approximately 7% to well above 30%. Some of this can be attributed to the fact that consumers couldn't spend due to shutdown orders. However, the figure in September was still at historically high levels, despite most states have at least partially relaxed their social distancing policies. This tells us that American consumers are choosing to save more as they face a high degree of uncertainty. Second, evidence suggests that we're spending our money on different goods and services than pre-pandemic period. One notable example is the decline in spending at restaurants and bars, which is shown in red. Instead, we're spending more at grocery and liquor stores, as the blue line suggests. Again, some of this could be due to limited dining-in options, and the red line did recover somewhat in recent months. However, as we approach winter months, spending at restaurants is likely to drop. Third, in addition to changes in what consumers are buying, we have seen a change in how consumers are buying goods as well. This graph shows the share of online sales relative to total retail sales. While this figure has been increasing steadily for the past 2 decades, the increase was particularly pronounced for Q2 of this year, when the share jumped from around 11% to 16%. Consumer behavior isn't the only thing that has changed since the start of the pandemic. We also see that how we work has certainly changed since February. Our colleagues in the Dallas Fed recently published a study on commuting patterns across the United States. According to their study, the share of respondents working from home every day, represented by blue bars, increased from about 8% in February to above 20% in August. Meanwhile, share of those who commute every day, represented by red bars, decreased from over 70% in February to 50% in August. While these are significant changes that we see on average, work-from-home situation varies greatly by the type of jobs and by extension, education and ethnicity of those who tend to hold these jobs. The chart on the left breaks down the share of workers who work from home every day by education level, while the chart on the right breaks down the data by race. What we see from both charts is a clear contrast in commuting situation due to the pandemic. In February, there was virtually no difference in work from home by either category, but since May, we observe very pronounced differences, where white and more educated workers are significantly more likely to be working from home than their minority and less educated counterparts. With the remaining few minutes, I will discuss the near-term outlook and factors that affect the path for recovery. We have now come full circle to looking at the GDP numbers again. In particular, let's now look at the predictions for the future. According to our survey of professional forecasters, the respondents' projection for economic growth in 2021 remains largely unchanged as of mid-August, with considerable amount of uncertainty. For example, the forecasters predict that there is more than a 10% chance that the overall growth in 2021 will be negative. At the same time, they also predict that there is a 25% chance that the annual growth rate in 2021 will be more than 4%. So, the point here is that it is hard to predict precisely what will happen simply because there are many unknowns that can heavily influence the outlook. Another way to think about recovery is by looking at employment data. This chart shows the number of months it took the US labor market to fully recover from each of the recent recessions, with the current recession plotted in black. For example, in the aftermath of the Great Recession, plotted in blue, you see that it took us almost 80 months to fully recover. While the recovery in the current recession has been solid so far, the pace has been slowing down in the recent months. Again, with so many uncertain factors in the economy, the timeline to full recovery remains unclear. Going forward, one area of concern for businesses is the fact that we're starting to see some evidence of business failures. In particular, if you look at the panel on the right, you can see that business Chapter 11 cases have been filed at one of the fastest paces in the last 15 years. As businesses look to reorganize their debts, they may be hesitant to commit to large investments, further slowing down recovery. Turning to consumers, one potential risk is that we may start seeing more consumer loan defaults. I don't mean to self-promote my work, but I recently co-authored an article that talks about this topic. So far, we're not seeing many cases of personal bankruptcies or defaults, but we think this may be because they are simply not being reported. Specifically, under the CARES Act, personal debts and forbearance agreements are not counted as delinquent. Therefore, once these agreements expire, we could all of a sudden see higher default rates. In this penultimate slide, I would like to briefly discuss some factors affecting the outlook. First, this is a crisis caused by a pandemic. Therefore, until we have a clear idea about when to expect to get a vaccine as well as effective treatment, it is difficult to imagine that the situation will change dramatically. The second factor is related to the first. At this point, we still have very limited understanding of the virus and the disease. Third, we see that business owners across the country are unsure of what to expect, which can alter the path to recovery. Fourth, as we have discussed, there is uncertainty of changes in consumer behavior. In particular, poor labor market conditions have led to less spending so far, but we do not know how long this will continue. Finally, there are questions of if, when, and how much of additional support from the government. Many of the relief programs established by the CARES Act have already expired or are about to expire. This last slide summarizes the key questions we have discussed in this presentation. First, in terms of the impact of businesses, while we are starting to see some signs of recovery, we still have a long way until full recovery. Second, lower consumer confidence has resulted in significantly less spending on certain goods and services, with some evidence of further decline in future spendings. Finally, in terms of near-term outlook, we know that the pace of recovery has slowed down in the most recent months. As we head into winter months, we may face greater uncertainty both in terms of spread of the virus and economic activities. This concludes the presentation. Thank you for joining me, and I look forward to your questions and comments. Above all, I very much look forward to addressing the Chamber next fall in person. Stay safe and take care.